Something unusual is about to hit the silver market, and the timing could not be more dangerous. Tomorrow, trading enters what professionals quietly call a ghost week, a period where liquidity thins out, volume disappears, and prices can move violently with very little warning. In these conditions, silver doesn't drift, it gaps. And right now, the structure of the market suggests that gap could be as large as $8 in either direction, catching unprepared investors completely off guard. On the surface, silver looks calm. Charts show tight ranges, controlled movements, and the illusion of stability, but calm markets are often the most deceptive. Beneath that surface, participation is dropping, order books are thinning, and real demand is no longer lining up with paper pricing. When fewer traders are present and fewer contracts change hands, even small imbalances can trigger outsized moves. This is why ghost weeks matter. They expose stress that normally stays hidden. Silver is entering this period with unresolved pressure already built into the system. Physical demand has not eased. Industrial consumption remains elevated, and yet futures markets continue to signal restraint. That disconnect is the fault line. When the market is liquid, these contradictions can be papered over. When liquidity vanishes, price has no choice but to adjust quickly and brutally. This matters far beyond day traders or speculators. Silver sits at the heart of critical industries: energy, electronics, defense, medical technology. It also functions as a monetary metal, a quiet barometer of trust in currencies and financial systems. When silver moves suddenly, it is rarely just about silver. It reflects stress moving through the broader economic structure. What makes the current moment alarming is who is driving demand and who is stepping back. In recent weeks, commercial users have continued to secure physical supply, often outside the public spotlight. At the same time, large financial players have reduced visible exposure, choosing to wait rather than commit capital during a low liquidity window. That imbalance creates vulnerability. One side needs metal, the other side is absent. Price becomes the messenger. Official prices still suggest order. Futures curves appear orderly. Volatility indicators remain muted. But these signals depend on participation. When volume dries up, indicators lag reality. This is how gaps form. The market closes at one level and reopens at another, with nothing in between. Stops don't trigger, orders don't fill. The move simply happens. The idea of an $8 gap may sound extreme to casual observers, but silver has a long history of disproving assumptions during thin trading periods. Because it is a smaller market compared to equities or major currencies, it doesn't require massive capital to move it. It requires imbalance, and imbalance is exactly what ghost weeks create. Physical premiums offer a clue. While paper prices hold steady, physical silver continues to trade with stubbornly high premiums in multiple regions. That tells us the metal itself is not abundant. It is being absorbed, locked away, consumed. Paper contracts can multiply endlessly, but physical ounces cannot. When the paper market is forced to reconcile with physical reality, it does so through sudden repricing, not gentle adjustment. Mainstream coverage rarely discusses this dynamic. Media prefers clean narratives and stable charts. Sudden gaps don't fit neatly into forecasts or analyst models. But markets don't care about narratives. They care about flows. And right now, flows are uneven. The ghost week amplifies every existing weakness. Algorithms step back. Market makers widen spreads or disappear entirely. Hedgers delay action. What remains is a fragile structure where price can jump to wherever the next real buyer or seller is willing to transact. If that level is far away from the last traded price, the gap becomes unavoidable. There's also a psychological component. When markets reopen after a gap, participants scramble to understand what they missed. Fear and urgency replace patience. This feedback loop can extend the move beyond what fundamentals alone would justify. In silver, these episodes often become reference points, levels that the market remembers long after the dust settles. The risk is not just to those positioned incorrectly. It is to the assumption that markets always offer an exit. During gaps, exits don't exist. Price leaps over them. This is why experienced traders treat low liquidity periods with respect, especially when unresolved pressure is already present. Right now, silver carries unresolved pressure from multiple directions: persistent physical demand, constrained supply growth, and a paper market reliant on confidence rather than delivery. The ghost week removes the buffer that usually absorbs these forces. What remains is raw exposure. If the gap materializes upward, it will force a reassessment of value almost instantly. Shorts will be pressured, hedgers will chase, analysts will revise narratives after the fact. If the gap materializes downward, it will not signal abundance, but shock, a forced liquidation in an illiquid environment, one that often rebounds just as violently. Either outcome carries consequences. Prices don't move $8 in silver without sending signals through supply chains, balance sheets, and sentiment. The move itself becomes information, revealing where stress truly resides. This is why the warning matters. Not because outcomes are guaranteed, but because conditions are aligned. Ghost weeks don't create volatility on their own. They reveal it. They strip away the comfort of liquidity and expose the market as it really is. As trading enters this window, the silver market stands at a point of vulnerability. What happens next may unfold quickly, without headlines, without countdowns, and without second chances. When liquidity disappears, price speaks first, and explanations follow later. The underlying forces driving this risk are rooted in structural realities that have been building for years. Silver mining output has been relatively flat, and much of it comes as a byproduct of other metals. That means supply growth is slow, reactive, and highly sensitive to shifts in demand for base metals like copper and zinc. At the same time, industrial consumption continues to rise, particularly in sectors critical to technology, renewable energy, and electric vehicles. Every ounce consumed in these industries is one less ounce available to balance speculative or paper-driven demand. China, once again, plays a pivotal role in the unfolding narrative. Buyers in the region have shown a relentless willingness to pay premiums to secure physical metal. These premiums are not trivial. They are historically significant, pointing to a scarcity that official global figures often obscure. While the Western markets continue to signal stability through futures and ETFs, the real physical flows tell a different story. When these flows are misaligned with paper positions, the market becomes a pressure cooker. This misalignment triggers a predictable cause and effect sequence. As premiums rise, arbitrageurs attempt to move metal from lower-priced markets to higher-priced ones. But when inventories are constrained, arbitrage fails to converge prices. Instead, it magnifies the discrepancy, forcing participants to compete for scarce supply. Each transaction, each premium paid, feeds back into the system, increasing the likelihood of abrupt moves during low liquidity periods. Historical patterns reinforce this logic. Similar setups have led to explosive outcomes in silver before. Periods of thin trading combined with tight supply and surging physical demand have produced sudden gaps, rapid repricing, and volatile swings. The Ghost Week effect merely accelerates these dynamics by removing the market's usual safety nets: liquidity, broad participation, and smooth order flow. The consequences of a gap, whether up or down, extend beyond immediate trading. An upward gap would signal that physical demand has overwhelmed paper markets, forcing a sudden revaluation and compelling participants to reassess their exposure. Downward gaps, while appearing less dramatic in headline terms, often indicate forced liquidations in an environment where exit options are limited, creating stress that ripples across hedging strategies and global positions. Investors and industrial players alike are affected because silver is not merely an investment, it is a crucial input. Unexpected volatility disrupts pricing models, cost forecasts, and risk assessments. Governments and central banks, while not directly intervening in silver, watch closely because commodity stress can influence broader economic signals, investor sentiment, and currency dynamics. The psychology of markets during Ghost Weeks cannot be overstated. Fear and urgency replace measured analysis, particularly when price action is disconnected from the last known reference point. Market participants are forced to act on incomplete information, magnifying moves, and creating feedback loops that amplify the original imbalance. In silver, this effect is especially pronounced due to the relatively small size of the market and the significant proportion of physical demand relative to paper contracts. All of these factors converge to create a precarious situation. The combination of persistent demand, constrained supply, thin liquidity, and an unusual trading period sets the stage for potential dislocations. The $8 gap is not a certainty, but it is a realistic possibility when viewed through the lens of structural imbalances and historical precedents. Participants watching closely in Asia and North America are already positioning for potential shocks. Those who recognize the signals understand that the market is at a junction. Either a repricing will occur to reconcile physical scarcity with paper claims, or the discrepancy will widen further, increasing the severity of any eventual correction. The tension is palpable, and the stakes are high because gaps in silver do not merely reflect trading errors, they reveal systemic pressure points. In this environment, conventional indicators become unreliable. Standard measures of volatility, open interest, or volume may not capture the subtle undercurrents building beneath the surface. Premiums in physical markets, delivery times, and regional spreads become more accurate barometers of stress. Analysts who rely solely on futures or ETFs risk underestimating the potential magnitude of moves during low liquidity periods like Ghost Week. The lesson from history and from current market conditions is clear. When structural pressures meet periods of thin participation, the market becomes vulnerable to abrupt shifts. These shifts do not require a triggering news event. They are the natural result of the forces already at work. And in silver, a market with both industrial and monetary significance, the implications extend beyond trading desks to the broader economy. As trading commences during Ghost Week, every movement, every spike in premium, every order filled at the margin becomes part of a larger narrative. Market participants are not just reacting to price, they are responding to scarcity, timing, and systemic pressure. This convergence of factors makes the period inherently dangerous, and yet inherently revealing. Those who observe carefully will notice patterns. Repeated attempts to secure metal, delays in settlement, widening spreads between physical and paper prices, and subtle shifts in investor behavior. These patterns are not random. They are indicators of an underlying imbalance that is reaching its natural limit. The gap, if it occurs, is the market's way of forcing reconciliation between expectation and reality. In the coming hours, as trading volumes contract and liquidity evaporates, the silver market may provide one of its clearest signals yet. The gap could occur suddenly, creating a price movement that seems disproportionate to recent trends, but is, in fact, a logical outcome of the pressures that have been building invisibly. This is not speculation. It is the predictable outcome when structural factors align in a fragile system. The implications for investors, industrial users, and global observers are profound. Sudden repricing can affect hedging strategies, cost structures, and portfolio allocations. Even those not directly invested in silver may feel indirect consequences through broader commodity markets, financial instruments tied to metals, and economic indicators sensitive to sudden price swings. The ghost week effect amplifies both the risk and the informational value of these movements. The overarching lesson is that markets speak clearly when conditions are extreme. Silent imbalances, once exposed, leave little room for gradual adjustment. Silver's inherent dual role as both a physical commodity and a monetary metal ensures that such exposures are noticed quickly, interpreted carefully, and responded to decisively. What appears as a gap is more than a numerical move. It is a signal of deeper forces at play, revealing stress, scarcity, and the limits of conventional market assumptions. Liquidity is the lifeblood of any market, and during ghost weeks, that lifeblood slows to a trickle. When trading volumes drop, every action, every order, every transaction carries disproportionately more weight. Silver, smaller and more specialized than gold or oil, is especially sensitive to these fluctuations. In normal times, a few thousand ounces changing hands might barely move the market. During a ghost week, the same activity can trigger sudden jumps or drops, creating an environment where even experienced participants must tread carefully. Physical silver continues to tell a story that paper prices ignore. Across Asia, premiums remain elevated, reflecting real scarcity and strong demand. Industrial consumers, from solar panel manufacturers to electronics producers, cannot pause production simply because futures markets appear stable. Their urgency forces them to pay more for immediate delivery, pulling metal out of circulation. Each ounce consumed or hoarded reduces the margin for error in the market, narrowing the gap between stability and sudden repricing. Historical parallels offer a sobering perspective. Thin market episodes, combined with pre-existing pressure, have often resulted in sharp gaps that leave lasting impressions. In previous years, low volume periods during significant holidays or geopolitical events produced moves that startled even veteran traders. These were not isolated incidents. They were repeatable patterns, showing how market structure interacts with human behavior under stress. The cause and effect chain is straightforward yet relentless. Rising physical demand drives premiums higher. Higher premiums signal stress to the broader market. Reduced liquidity magnifies reactions. Paper contracts, unable to reflect scarcity in real time, fall behind reality. When participants realize the disconnect, rapid adjustments occur, often exceeding rational expectations. In essence, Ghost Week acts as an amplifier, turning subtle tension into pronounced market events. The turning point occurs when a critical mass of orders converges in a low liquidity environment. Stops may cascade, margin calls trigger, and automated trading systems react to price gaps rather than fundamentals. What was previously a silent buildup transforms into kinetic energy, released suddenly across exchanges. The result is the gap itself, a manifestation of latent market pressure demanding expression. Implications extend far beyond immediate traders. Investors relying on silver as a hedge, institutions maintaining exposure through futures, and industries dependent on consistent metal supply all feel the effects. Supply chains may experience temporary disruptions. Price discovery mechanisms are tested. The market communicates its limits, reminding participants that leverage and paper claims cannot substitute for tangible assets. Best-case scenarios see the gap quickly absorbed, with volatility normalizing as liquidity returns. Markets find equilibrium, participants recalibrate, and confidence stabilizes. Worst-case scenarios involve extended dislocations, where pricing extremes persist until physical supply catches up or speculative positions unwind. The outcome may appear chaotic, but it is the natural resolution of structural imbalances. Understanding ghost weeks is crucial for anyone interacting with silver markets. They do not create risk artificially, they merely reveal latent conditions. By observing premiums, supply pressures, and market behavior, participants gain insight into the real forces at work. The lesson is clear. Markets are not always what they seem, and periods of low participation can hide, then suddenly expose significant vulnerabilities. As the ghost week begins tomorrow, the silver market is poised at a fragile equilibrium. Pressure from physical demand, reduced liquidity, and structural imbalances converge, creating conditions ripe for sudden movement. The warning is not sensational. It is a factual assessment based on observed market behavior, historical patterns, and current physical realities. Those watching closely will see signals unfold before prices leap or drop, and those who ignore them risk being caught unprepared. The coming days will serve as a real-time test of how paper markets and physical demand interact under stress. Every trade, every order, every decision contributes to the unfolding narrative. The gap is not guaranteed, but the potential is undeniable. Markets will communicate the truth of supply, demand, and liquidity in their own unmistakable language, and the response will be swift, revealing, and consequential. In the end, silver does not move quietly when the conditions align. Ghost Week exposes weakness, scarcity, and imbalance. It forces the market to reconcile paper with reality, often in abrupt fashion. Observers and participants alike must recognize that these are the moments when latent risk becomes visible, when hidden tension transforms into action, and when a carefully monitored market suddenly demands respect. The silver market stands at such a juncture, and as the week unfolds, the story will be written not by forecasts or headlines, but by the relentless dynamics of supply, demand, and liquidity. The interplay between industrial demand and investor behavior is now more critical than ever. Manufacturers cannot pause production simply because liquidity is thin, and investors cannot ignore rising premiums if they wish to protect their positions. Each side feeds the other. Urgent buying by one group signals scarcity to the other, which then reacts by increasing its own demand or adjusting positions. This feedback loop magnifies movements, making even relatively small orders capable of creating outsized price shifts. The stage is set for volatility to manifest in ways that the broader market has not fully anticipated. Additionally, global macroeconomic factors amplify the potential impact of Ghost Week. Central banks continue to navigate a delicate balance between inflation, interest rates, and economic growth, while geopolitical tensions add uncertainty to supply chains. Silver, uniquely straddling the worlds of industrial use and monetary value, reacts sensitively to these pressures. It is not merely a commodity, it is a barometer of systemic confidence. When confidence is tested, the metal responds with clarity and force. One of the subtle but dangerous aspects of the upcoming week is the convergence of multiple stress points. Physical shortages, elevated premiums, paper market leverage, and low liquidity coincide. Alone, any one of these factors might create temporary dislocations. Combined, they create an environment in which price gaps are not only possible, they are likely. Historical precedents show that periods like this do not wait for consensus. They impose their own logic, and participants are forced to react in real time. The market's memory of past events plays a role as well. Traders who have witnessed previous gaps understand the consequences and adjust their strategies, sometimes exacerbating moves. Those who have not experienced such events may be caught by surprise, compounding volatility. Automated trading systems, programmed to respond to technical triggers, do not distinguish between informed decisions and panic. They execute orders that amplify existing flows. In a low participation environment, this can accelerate moves beyond what traditional models predict. As the Ghost Week unfolds, the first signs of tension may be subtle. Minor spikes in premiums, slight delays in physical deliveries, or unusual order book patterns. These are not anomalies. They are signals. Each is a piece of a larger puzzle indicating that pressure within the silver market is approaching a threshold. Once this threshold is crossed, the system adjusts rapidly, and the market gap materializes. Participants observing these early signals can anticipate the move, while those ignoring them risk exposure to sudden and sharp repricing. The implications for investors and industrial users are profound. Positions that appear secure under normal conditions may be highly sensitive during this week. Supply chains, reliant on timely delivery, may face unexpected interruptions. Financial instruments tied to silver, whether through ETFs, futures, or options, can experience extreme swings in value. Understanding the interconnectedness of these factors is essential for interpreting the movements that are likely to occur. Ghost Week also tests the resilience of risk management strategies. Stops, hedges, and diversification all function differently in low liquidity, high-pressure conditions. Traditional assumptions about how markets respond may fail, forcing a reevaluation of exposure and tactics. In these moments, the market communicates its rules with uncompromising clarity. Scarcity and urgency dictate outcomes, not conventional expectations or models. The pressure is not indefinite. Ghost Week is temporary, but the effects can be lasting. Once the market has corrected for imbalances, premiums may normalize, liquidity returns, and the apparent calm resumes. However, the lessons persist. Market participants gain insight into the fragility of pricing mechanisms, the importance of physical demand, and the potential consequences of structural imbalances. Those who recognize the signals will have understood a rare window into how silver truly responds under constrained conditions. As this period commences, Every participant is a part of the unfolding narrative. Trades are not merely transactions. They are the manifestation of tension, demand, and scarcity being resolved in real time. The $8 gap, whether realized upward or downward, is the visible expression of pressures that have accumulated quietly. It is a reminder that markets are living systems, responsive to physical realities and human behavior, and capable of delivering abrupt adjustments when conditions align. Ultimately, Ghost Week exposes the underlying truths of the silver market. It highlights the difference between paper representations and tangible assets, between theoretical stability and real-world scarcity, between assumptions of liquidity and its sudden absence. For those watching carefully, it provides both warning and insight. Markets can move swiftly, unpredictably, and with consequences that extend far beyond simple price changes. The upcoming days will not be remembered for their calm, but for the clarity they provide about how silver, scarcity, and confidence intersect. As the days of Ghost Week progress, the market will begin to reveal where pressure points exist. Early indicators may include abrupt shifts in bid-ask spreads, delayed delivery confirmations, and sudden spikes in premiums for nearby physical silver contracts. These are subtle signs that liquidity is evaporating in critical areas. When such conditions coincide with persistent demand, the market moves not incrementally, but in leaps, forcing participants to adapt or face unintended consequences. This is not speculation. It is the predictable outcome of structural stress under constrained trading conditions. Physical demand remains the linchpin. Industrial users, particularly those in high-tech manufacturing and renewable energy, continue to draw silver from available inventories. Unlike paper contracts, these ounces cannot be conjured at will. Each transaction removes tangible metal from circulation, exacerbating the imbalance between what exists physically and what is represented on exchanges. As supply diminishes in real terms, any attempt to cover positions or fulfill contracts becomes increasingly costly, driving premiums higher and creating conditions ripe for the projected $8 gap. Historical context reinforces the severity of these conditions. Previous low liquidity periods, especially during times of geopolitical or economic uncertainty, have repeatedly demonstrated the market's propensity to gap sharply when latent pressures converge. These are not isolated events. They are patterns that repeat because the underlying mechanics of supply, demand, and human behavior remain consistent. By understanding these precedents, observers can anticipate how similar dynamics may play out in the current environment. The mechanics of the gap are straightforward, yet unforgiving. When demand outstrips available supply and liquidity is thin, price must adjust to find equilibrium. Automated trading systems, programmed to react to price thresholds, amplify these movements. Stops cascade, margin calls trigger, and participants are forced to recalibrate positions under extreme conditions. This creates a feedback loop where the initial movement drives additional reactions, magnifying the effect and producing the gap observed on the market. Investor psychology further intensifies these dynamics. Awareness of Ghost Week heightens sensitivity to price movements, and market participants respond quickly to perceived threats or opportunities. Even modest fluctuations can prompt aggressive adjustments, as confidence in orderly execution is limited during thin trading periods. The $8 gap is not merely a projection. It represents a plausible manifestation of these combined forces, where both rational decision-making and reflexive responses converge to produce significant price action. The potential impact extends beyond immediate trading outcomes. Dislocations during Ghost Week can ripple through supply chains, affecting production schedules for industries reliant on silver. ETFs and other silver-linked financial instruments may experience heightened volatility, challenging risk management strategies. Additionally, elevated premiums in physical markets may signal persistent scarcity, influencing long-term strategic decisions by investors and corporations alike. The gap, therefore, is both a symptom and a catalyst, revealing systemic tensions while simultaneously reshaping market behavior. Understanding cause and effect in this context is critical. Elevated physical demand increases premiums, which in turn signals stress to paper markets. Thin liquidity magnifies these reactions, while automated systems and investor psychology amplify the magnitude of movement. Each element reinforces the others, creating conditions in which sudden repricing is not only possible, but increasingly probable. Ghost Week functions as an amplifier, exposing vulnerabilities that would otherwise remain hidden in normal trading periods. Market participants who monitor these signals can gain insight into the forces shaping price action. Delays in physical delivery, spikes in premiums, and abrupt changes in bid-ask spreads are early warnings. Each serves as a measurable indicator that pressure is building, that scarcity is becoming tangible, and that the potential for a gap is real. Ignoring these signals risks being caught off guard, while recognizing them allows for informed positioning, awareness, and preparedness. In conclusion, the upcoming Ghost Week represents a convergence of stressors: elevated physical demand, constrained supply, thin liquidity, and structural imbalances in paper markets. These factors combine to create conditions in which the projected $8 gap is not hypothetical, but a plausible and foreseeable outcome. The market is entering a period where latent pressure will seek expression, and participants must remain aware of how quickly circumstances can change. Silver's movements in the coming days will serve as both warning and lesson, illustrating the intersection of scarcity, liquidity, and market psychology in a high-stakes environment. The unfolding dynamics of Ghost Week also highlight a crucial distinction between paper markets and physical reality. Futures contracts and derivatives often give the impression of abundance, suggesting that supply can meet demand at any time. Yet physical silver tells a different story. Premiums, delivery delays, and regional scarcity indicate that actual metal is finite and that the market is operating under real constraints. When the gap eventually manifests, it will be the physical realities of the market asserting themselves, overriding theoretical or abstract assumptions embedded in paper instruments. This week, every ounce of silver that moves matters. Industrial users securing supply, investors hoarding physical metal, and speculators adjusting positions all contribute to a delicate balance. The smaller the liquidity, the more pronounced each transaction becomes. Unlike other commodities, silver's dual role as both an industrial metal and a store of value magnifies its sensitivity. In times of constrained trading, these overlapping roles amplify the effects of even minor imbalances. Geopolitical developments further compound risk. Supply chains for precious metals are global, with key production hubs concentrated in specific regions. Any disruption, whether due to policy changes, trade restrictions, or logistical bottlenecks, can remove ounces from circulation suddenly. Ghost Week, by thinning participation and reducing market depth, magnifies the impact of these external shocks. What might have been a minor correction in normal conditions can transform into a pronounced gap under these circumstances. The behavior of market participants during these periods is also instructive. Experienced traders understand that conventional indicators may be unreliable. They recognize that volume is not merely low, it is selectively concentrated, often hiding the true magnitude of pressure building beneath the surface. Automated trading systems exacerbate the effect by reacting to mechanical triggers rather than contextual fundamentals. Combined with human reflexes, panic, urgency, and strategic repositioning, the conditions are primed for sharp movements. As Ghost Week progresses, early signs of imbalance will likely include surges in localized premiums, sudden delays in fulfilling physical contracts, and widening bid-ask spreads. Each of these indicators signals growing stress and diminished liquidity. When participants respond, the market gap begins to form. The $8 range is not arbitrary. It reflects the potential movement created by the convergence of these forces within the low participation environment. The implications extend beyond traders and investors. Industries reliant on timely silver deliveries, from electronics manufacturing to renewable energy production, may experience operational impacts. Financial instruments tied to silver exposure, such as ETFs, mutual funds, and derivative products, will reflect heightened volatility. Additionally, these movements provide insight into the health of the broader precious metals market, signaling where scarcity, leverage, and liquidity intersect in ways that are visible only during periods like Ghost Week. Understanding the causal relationships is key. Elevated physical demand drives premiums upward. Reduced liquidity magnifies price sensitivity. Automated systems amplify responses. Investor psychology reacts to perceived urgency. Each component reinforces the others, creating a self-reinforcing cycle. Ghost Week serves as the catalyst, stripping away normal buffers and allowing latent pressures to materialize into observable price gaps. The market's response is both a warning and a signal. It communicates the limits of conventional market structures and the importance of physical supply. It demonstrates that paper representations, while convenient, cannot fully capture the constraints inherent in tangible assets. The projected $8 gap is a manifestation of these truths, where accumulated pressure finds its most immediate and visible outlet. Ultimately, Ghost Week is a test of market resilience and preparedness. It exposes vulnerabilities that are otherwise hidden and emphasizes the importance of understanding the interplay between supply, demand, liquidity, and psychology. Silver's behavior during this period will provide critical lessons for both current participants and future observers, illustrating how latent pressures, when combined with structural constraints, can result in sudden, pronounced, and consequential movements. The convergence of multiple stress factors during Ghost Week also highlights the fragile interdependence between physical and paper markets. Futures and derivative contracts often give participants a sense of control or predictability, but in reality, they are contingent on the availability of actual metal. As physical supply tightens, the reliability of these instruments is tested. When discrepancies between paper and physical markets widen, the market is forced to reconcile the two, often in abrupt, visible ways. This reconciliation is what creates the potential for sudden gaps and intense volatility. Another critical aspect is the role of market memory. Traders who have experienced previous low liquidity episodes approach ghost weeks with heightened caution, anticipating that even minor imbalances can cascade into significant moves. Their actions, tightened risk management, selective participation, and strategic hedging, interact with automated trading systems, creating feedback loops that amplify price movements. Meanwhile, participants without prior experience may misinterpret early signals, contributing to more pronounced reactions as the gap develops. Physical premiums continue to serve as a crucial barometer. When premiums spike, they reflect immediate scarcity and urgent demand, signaling that the market is absorbing more metal than it is releasing. These elevated premiums are often localized, varying by region and delivery timeframe, but collectively they provide a real-time view of market stress. Investors and industrial users monitoring these signals gain insight into how supply constraints are evolving and how paper markets may be forced to adjust accordingly. The behavioral dynamics of investors and traders are also amplified during Ghost Week. Awareness of potential gaps increases sensitivity to price movements, prompting rapid repositioning and sometimes overreaction. These responses, when combined with thin liquidity, create the conditions for sudden, pronounced gaps. The $8 range is not a speculative exaggeration. It reflects the cumulative effect of elevated physical demand, reduced participation, and structural stress in the paper market. Historical precedents reinforce the plausibility of such a move. Similar low liquidity periods in the past have produced gaps that surprise both professionals and casual participants. These events consistently demonstrate that markets are highly sensitive to imbalances when buffers disappear. The current environment, marked by persistent demand, constrained supply, and the unique characteristics of Ghost Week, mirrors these historical conditions closely, suggesting that a significant move is both possible and likely. The gap itself is more than a price phenomenon. It is a signal of systemic pressure. It conveys information about the health of supply chains, the reliability of paper contracts, and the responsiveness of market participants. Every executed trade, every delayed delivery, and every shift in premiums contributes to this emerging narrative. The market communicates its status through these actions, and participants who observe closely can discern patterns, anticipate responses, and understand the underlying drivers of volatility. For investors and industrial users, the implications are clear. Positions that appear stable under normal conditions may be exposed during periods of low liquidity. Supply chains dependent on consistent metal delivery may face disruptions, and financial instruments linked to silver can experience sharp fluctuations. Recognizing the signs of stress, rising premiums, delayed deliveries, unusual order book behavior provides valuable foresight into potential market movements and allows participants to make informed decisions in real time. Ghost Week is temporary, but its effects can be lasting. The sudden adjustment in prices, the repricing of risk, and the exposure of underlying vulnerabilities provide lessons that persist beyond the immediate trading period. Observing these dynamics offers insight into the market's sensitivity to supply constraints, liquidity shortages, and investor behavior, highlighting the ways in which silver operates both as an industrial commodity and a store of value. Ultimately, the upcoming week is a critical test of market structure. The projected $8 gap is not a hypothetical scenario. It is a plausible outcome based on observable market pressures, historical behavior, and the unique conditions created by Ghost Week. As the market navigates these days, every participant will witness the interplay between physical scarcity, liquidity, and psychology. Silver will not move quietly. Its shifts will be abrupt, revealing, and consequential, offering a stark reminder of the forces that shape price when normal conditions no longer apply. The unfolding events of Ghost Week also illuminate the delicate balance between expectation and reality in the silver market. Many participants rely on historical stability, assuming that price will adjust gradually and predictably. Yet periods of thin liquidity, elevated physical demand, and structural imbalances consistently prove that markets do not operate on assumption alone. They respond to real constraints, and when those constraints collide with low participation, sudden, sharp price movements are almost inevitable. Physical demand remains the driving force behind this stress. Industrial users cannot pause their operations. They require silver to meet production timelines for electronics, renewable energy technology, and specialty applications. Investors seeking tangible exposure also withdraw ounces from circulation, further reducing availability. Each transaction removes metal from the system, tightening supply and heightening the sensitivity of price to even minor orders. During Ghost Week, when liquidity is low, these transactions carry disproportionate weight, making gaps in price more likely. Premiums in regional physical markets are an early warning signal. Elevated premiums indicate that buyers are willing to pay significantly more to obtain immediate delivery. While futures markets may appear calm, these premiums reveal a hidden imbalance, the tangible scarcity of silver. The gap, whether upward or downward, is the market's method of reconciling this discrepancy between paper representations and physical reality. Historical analogs reinforce this perspective. In previous low liquidity episodes, the market responded not incrementally, but in leaps. Even when volatility appeared muted beforehand, gaps materialized quickly, catching participants unprepared. Patterns repeat because the underlying mechanics of supply, demand, and human reaction remain consistent. Ghost week functions as a magnifier, exposing latent pressure that otherwise goes unnoticed. The interplay of human behavior and automated trading is another factor. Traders act on perception, algorithmic systems react to thresholds, and both interact in ways that amplify movement. In a low participation environment, the combined effect can be dramatic. Minor shifts in physical demand or order flow can cascade into substantial price changes. This creates conditions where an $8 gap is not only plausible, but aligned with the mechanics observed in past periods of similar stress. Liquidity, or the lack thereof, is central to understanding the potential movement. When order books are thin, prices can leap between willing buyers and sellers without intermediate transactions. Stops cascade, margin calls trigger, and market participants are forced to react instantaneously. The absence of depth ensures that small pressures translate into large price movements. Ghost week removes the buffer that would normally absorb these forces, leaving the market exposed. Investor psychology compounds the effect. Awareness of Ghost week heightens sensitivity to price movement, prompting preemptive actions, hedges, and position adjustments. Each reaction feeds the other, producing a feedback loop that magnifies volatility. Those who underestimate the structural stress risk being caught in a rapid repricing, while those who observe and interpret the signals gain foresight into potential outcomes. The broader implications extend beyond traders and speculators. Industries dependent on timely silver deliveries may experience operational challenges. ETFs and derivative instruments linked to silver will reflect heightened volatility. Market participants gain insight into the limitations of paper representations versus physical realities. The projected $8 gap is a tangible manifestation of these underlying pressures and the interaction between liquidity, demand, and market psychology. Ghost week ultimately serves as a stress test for the silver market. It exposes the interplay between scarcity, demand, and market depth in ways that are otherwise obscured during normal trading periods. Observing these dynamics offers insight into the market's structural vulnerabilities and provides context for understanding price movements that may otherwise appear abrupt or inexplicable. As trading continues, every transaction, every order, and every premium adjustment becomes a signal of the market's underlying tension. The gap represents more than a price movement. It is a reflection of accumulated pressure seeking resolution. Silver's behavior during this period will demonstrate how physical scarcity, low liquidity, and psychological reactions converge to produce movements that are rapid, pronounced, and consequential. The looming Ghost week also underscores the importance of understanding how global supply chains influence market behavior. Silver is not confined to a single exchange or region. It flows through complex networks connecting mines, refiners, industrial users, and investors worldwide. Disruptions anywhere along this chain, whether due to logistics, regulatory constraints, or heightened local demand, can magnify pressure during low liquidity periods. Ghost week acts as a spotlight, exposing these vulnerabilities and forcing rapid adjustments that may not have been anticipated under normal trading conditions. Physical scarcity drives market behavior more than paper representations ever can. Each ounce secured by industrial users or investors reduces available supply, tightening the system incrementally yet significantly. When liquidity is limited, these small reductions are amplified in price movements. The $8 gap projected for this period is a realistic expression of cumulative stress, the convergence of demand, unlimited supply, and diminished market depth. Historically, markets during periods of constrained liquidity reveal their true structure. Apparent stability in charts can be misleading. Low-volume trading often masks the underlying tension. Once a critical threshold is reached, whether through physical withdrawals, elevated premiums, or a sudden shift in orders, the market can leap to a new equilibrium in a single session. Silver's dual role as both an industrial and monetary asset increases its sensitivity to these dynamics, as the metal responds to real-world scarcity in addition to speculative positioning. Investor and trader behavior adds another layer of complexity. Awareness of Ghost week heightens responsiveness to minor price changes, creating preemptive adjustments and reactive maneuvers. Algorithmic trading systems, reacting mechanically to triggers, further amplify these movements. In combination, these factors transform a period of low liquidity into a high-stress environment where even modest pressures can produce outsized results. The projected $8 gap is not merely theoretical. It represents the synthesis of these structural and behavioral factors. Elevated physical premiums, thin order books, constrained liquidity, and human psychology all converge to create conditions in which rapid, significant repricing is plausible. Every transaction during Ghost week becomes disproportionately influential, contributing to the ultimate movement in price. Implications extend beyond short-term trading. Operational supply chains dependent on silver may encounter delays or increased costs. Financial instruments, including ETFs and derivative positions, may experience heightened volatility. More broadly, these dynamics illustrate the limitations of paper markets in fully representing physical scarcity. The gap, when it occurs, is a vivid demonstration of these structural truths. Ghost Week serves as both a warning and an opportunity for observation. Markets reveal their vulnerabilities when conventional buffers are removed, and silver, with its unique market characteristics, is particularly exposed. Understanding the interplay of supply, demand, liquidity, and psychology allows participants to interpret movements as information rather than anomaly. The $8 gap is the market communicating the resolution of accumulated stress, a tangible reflection of pressures that have been quietly building beneath the surface. The period ahead demands vigilance. Observers who monitor premiums, delivery times, order book activity, and trading patterns can gain insight into how pressure is evolving. Each signal contributes to a broader understanding of market mechanics, providing context for movements that may otherwise seem abrupt. Silver's response during Ghost Week will illustrate how latent imbalances, once exposed, can produce rapid and consequential price adjustments. Ultimately, Ghost Week is a test of market structure, resilience, and awareness. It strips away the illusions of stability, forcing participants to confront the realities of scarcity, liquidity, and human behavior. The projected $8 gap is a manifestation of these forces, revealing how the convergence of physical demand, constrained supply, and low participation translates into abrupt market movements. As this week unfolds, silver will communicate its truths with precision, demonstrating that price is not merely a number, but the expression of underlying market dynamics. The Ghost Week also serves as a stark reminder that markets are living systems, constantly balancing between supply, demand, and perception. When participation thins, these systems become highly sensitive to small shocks. A single large physical order, minor disruption in delivery, or an unexpected announcement can ripple through the market with amplified consequences. In silver, where supply is finite and demand persistent, these ripples are magnified, creating conditions where gaps are not just possible, they are probable. As the week progresses, monitoring early warning signs becomes critical. Premiums in physical markets, especially in regions with concentrated demand, provide a clear indication of stress. Delays in deliveries, rising spot prices, and widening bid-ask spread signal that the system is strained. These subtle indicators often precede larger market moves, offering a glimpse into the forces that will shape the coming gap. Human behavior adds another dimension. Traders and investors respond not only to price movements, but also to perceived risk. Awareness of Ghost Week heightens sensitivity, prompting preemptive adjustments. Automated systems, programmed to react to thresholds and triggers, amplify these responses. The combination of human and machine reactions in a low liquidity environment creates a self-reinforcing cycle, where minor pressures can quickly escalate into significant gaps. Historical precedent confirms this pattern. Periods of thin liquidity combined with structural imbalances have consistently produced sharp movements in silver and other precious metals. These episodes are not anomalies. They are recurring outcomes of predictable market mechanics. By studying past Ghost Weeks and similar low-volume periods, observers can anticipate how stress manifests and where vulnerabilities lie. The $8 gap, therefore, is not an exaggeration. It is a logical projection based on observable conditions: elevated physical demand, reduced participation, and structural constraints in paper markets. Each factor feeds into the next, creating an environment where sudden, pronounced price adjustments are not only possible but expected. Understanding this chain of cause and effect is essential for anyone involved in the market during this sensitive period. The broader implications are profound. Industries that rely on timely silver delivery may face operational challenges. Financial instruments linked to silver exposure, including ETFs, futures, and options, will reflect heightened volatility. Investors must recognize that paper markets, while convenient, cannot fully absorb the pressures inherent in physical scarcity. The gap will serve as a visible manifestation of these underlying market dynamics, providing insight into the true state of supply and demand. Ghost Week is temporary, but its lessons endure. It exposes the limits of liquidity, the importance of physical supply, and the influence of participant behavior. Every trade, every adjustment, and every premium movement contributes to the evolving narrative, illustrating how stress is resolved when normal market conditions are disrupted. Observers who recognize these dynamics gain a deeper understanding of the silver market, its vulnerabilities, and the interplay between tangible and paper assets. As the week unfolds, silver's movements will not be incremental or gentle. They will be abrupt, reflecting the convergence of multiple pressures in a thinly traded market. The projected $8 gap is a culmination of these forces, a manifestation of scarcity, liquidity constraints, and market psychology. Participants who watch closely will see the market communicate its truths in real time, providing a rare and instructive glimpse into how physical and paper realities converge under stress. Ultimately, Ghost Week is a proving ground. It demonstrates how markets respond when buffers are removed, when latent pressures are exposed, and when structural imbalances collide with low participation. Silver's behavior during this period will provide both warning and insight, highlighting the forces that shape price in ways that calm charts and conventional models often obscure. The $8 gap is not merely a prediction, it is the market asserting itself, revealing the consequences of pressure accumulated over time and expressed in a concentrated, unavoidable moment. Every movement in silver during Ghost Week is a lesson in market mechanics. The projected $8 gap represents not only a potential price adjustment, but also the reconciliation between physical scarcity and paper representations. When liquidity is thin, price does not negotiate gradually. It jumps to reflect the imbalance. Each participant's action, from industrial buyers securing ounces to investors adjusting positions, contributes to the emergent price path, transforming theoretical pressure into observable reality. Physical premiums continue to act as a barometer. Elevated premiums indicate that demand exceeds readily available supply, signaling stress to the broader market. When the gap occurs, it will crystallize these tensions, showing where scarcity is most acute. This is a core principle of market behavior. Tangible constraints, once revealed, dominate over assumptions embedded in paper contracts or historical price norms. Market psychology compounds the effect. Awareness of Ghost Week creates heightened sensitivity to minor price shifts. Traders preemptively adjust, algorithms react, and small imbalances are magnified. This interplay between human behavior and automated systems transforms a thin market into a high-stakes environment where minor miscalculations can lead to disproportionate outcomes. The $8 gap, in this context, is not merely plausible. It is the logical manifestation of these interacting forces. Historical comparisons reinforce this expectation. Low volume periods combined with structural imbalances have repeatedly produced sudden pronounced moves in silver. Each instance follows the same fundamental mechanics. Scarcity, liquidity constraints, and reactive participants converge to create abrupt adjustments. Ghost Week amplifies these dynamics, revealing latent stress that remains hidden during periods of normal activity. The implications extend beyond immediate trading outcomes. Industries dependent on silver may face temporary disruptions. Financial instruments tied to silver exposure, such as ETFs or derivative contracts, will reflect increased volatility. Moreover, the gap provides insight into broader market health, highlighting where physical scarcity, demand pressure, and paper market mechanics intersect. It is a tangible demonstration of how structural vulnerabilities manifest under constrained conditions. Understanding the cause and effect chain is essential. Elevated physical demand raises premiums, signaling stress. Reduced liquidity magnifies sensitivity, while algorithmic systems and investor behavior amplify movements. The Ghost Week acts as a catalyst, stripping away buffers and exposing latent pressures. The $8 gap is the market's resolution of accumulated tension, reflecting both the magnitude and urgency of the underlying forces. For investors and market observers, the lesson is clear. Periods of low liquidity expose hidden risk and create conditions for rapid repricing. The projected gap is not a hypothetical anomaly, but a reflection of the real pressures embedded in supply, demand, and market structure. Watching the market unfold during Ghost Week provides insight into how these forces interact and how price communicates the reconciliation between paper and physical realities. As trading continues, the $8 gap represents more than a numerical shift. It embodies the convergence of scarcity, liquidity, and behavior, illustrating the market's response to structural stress. Ghost Week transforms latent pressure into observable outcomes, offering both warning and understanding. Silver's movements will demonstrate that markets are dynamic systems, sensitive to real-world constraints, and capable of delivering sudden, consequential adjustments when equilibrium is disrupted. The coming days will be a vivid demonstration of these dynamics. The projected gap is the market speaking, revealing where pressures reside and how they resolve. Participants observing closely will witness the interplay between physical scarcity, liquidity constraints, and psychological reactions, gaining insight into the forces that shape price beyond conventional forecasts. Ghost Week, in this context, is not merely a period on the calendar. It is a lens through which the inner workings of the silver market are laid bare. The story of Ghost Week is ultimately one of revealed vulnerabilities. In normal conditions, markets operate with buffers, liquidity, participation, and depth that absorb imbalances and prevent abrupt moves. During Ghost Week, those buffers thin dramatically. Orders that would normally be absorbed are no longer cushioned, and each trade carries outsized influence. In silver, where supply is finite and demand persistent, this environment transforms small pressures into potentially significant gaps. The projected $8 movement is not an exaggeration. It is a manifestation of these converging forces. Physical markets continue to tell the underlying story. Premiums in multiple regions remain elevated, reflecting tangible scarcity that paper prices alone fail to capture. Industrial users and investors compete for limited ounces, further tightening the system. Each transaction, each withdrawal contributes to the underlying tension, preparing the market for an abrupt realignment once liquidity constraints interact with accumulated pressure. Historical precedents provide context and caution. Previous ghost weeks, low volume periods, or thinly traded sessions have consistently produced sharp, rapid adjustments in silver prices. These events follow a familiar pattern. Scarcity and urgency collide with low liquidity, and the market responds in leaps rather than incremental changes. Observers who understand this pattern can anticipate where stress is building and how it is likely to manifest. Investor psychology is another amplifying factor. Awareness of the potential for gaps induces heightened sensitivity, prompting preemptive position adjustments. Algorithmic systems, reacting mechanically to thresholds, further magnify movements. In this environment, minor imbalances cascade into pronounced outcomes, making the projected $8 gap a realistic representation of what could unfold. The implications of such a gap extend beyond trading desks. Industries relying on timely silver deliveries may face operational challenges. Financial instruments linked to silver exposure may experience sharp volatility, and supply chains may be temporarily disrupted. Moreover, the gap serves as a tangible indicator of where structural pressures exist, providing insight into the market's underlying vulnerabilities. Ghost Week functions as a stress test for the silver market. It exposes the limits of liquidity, the importance of physical availability, and the responsiveness of market participants. The projected gap is the culmination of these dynamics, a visible manifestation of pressures that have accumulated quietly over time. Observing these movements provides a rare window into how silver behaves when normal market conditions are stripped away and latent stress is forced to resolve. As the week progresses, every transaction, every premium spike, and every order adjustment becomes part of the unfolding narrative. The $8 gap is not simply a number. It represents the reconciliation between physical scarcity and paper market representation. Markets do not always move gradually, and during periods like Ghost Week, they rarely do. Price movements become the language through which the market communicates stress, scarcity, and the resolution of structural imbalances. Ultimately, Ghost Week is a period of revelation. It shows how interconnected factors, physical demand, liquidity constraints, investor behavior, and automated responses combine to shape price. Silver, as both an industrial and monetary asset, is especially sensitive to these forces. The projected gap, when it materializes, will reflect the cumulative effect of these pressures, providing insight into the market's mechanics and its reaction to constrained conditions. As the Ghost Week unfolds, one of the most important lessons becomes evident. Markets are not abstract constructs. They are reflections of tangible supply, human behavior, and systemic stress. In silver, this relationship is especially pronounced. Each ounce moved or withheld contributes to the overall tension, and in periods of thin liquidity, the consequences of these actions are magnified. The projected $8 gap is the natural resolution of accumulated pressure, where the market reconciles physical scarcity with paper-based expectations. Supply chain dynamics further intensify the situation. Silver is concentrated in specific production regions, refined in select facilities, and distributed globally. Any disruption, whether logistical, regulatory, or geopolitical, can reduce availability in key markets. During Ghost Week, when participants are fewer and market depth is shallow, even minor disruptions can have outsized impacts. The projected gap is thus not just a reflection of demand and liquidity, but also a response to the structural realities of the silver supply chain. Behavioral dynamics play a crucial role. Awareness of potential gaps prompts traders and investors to act preemptively, adjusting positions or seeking to secure physical ounces. Automated trading systems, programmed to react to specific thresholds, magnify these moves. The combination of human and algorithmic responses in a low participation environment creates a self-reinforcing cycle, amplifying volatility and making sharp adjustments more likely. Historical patterns provide context and validation. In past Ghost Weeks and other low liquidity periods, silver has repeatedly demonstrated sensitivity to structural stress. Gaps have formed when latent imbalances were exposed, often surprising participants who relied solely on conventional indicators or surface-level stability. The convergence of physical scarcity, reduced liquidity, and heightened awareness during the current period mirrors these conditions, making the $8 gap a plausible outcome. The implications extend beyond immediate traders. Industries relying on timely silver deliveries may face operational disruptions, while ETFs, derivatives, and other financial instruments linked to silver exposure will reflect increased volatility. More broadly, these movements illuminate the interaction between physical markets and paper representations, revealing how scarcity, liquidity, and human behavior converge to shape price. Ghost Week functions as both a test and a signal. It tests the resilience of market structures and the robustness of risk management strategies, while simultaneously signaling where latent pressures exist. The $8 gap is the market's method of communicating the resolution of accumulated stress, a visible manifestation of forces that have been quietly building beneath the surface. Participants observing these dynamics gain insight into the mechanics of silver under stress. Premium movements, delivery delays, and order book changes serve as early indicators of pressure. Each signal provides context for potential outcomes, illustrating how structural imbalances translate into observable price action. The market communicates through these movements, revealing its vulnerabilities and the consequences of constrained liquidity. Ultimately, Ghost Week underscores the intrinsic connection between physical reality and market pricing. Silver's dual role as an industrial and monetary asset makes it especially sensitive to stress. The projected $8 gap is not a speculative exaggeration. It represents the culmination of elevated physical demand, constrained liquidity, and reactive behavior. As the week progresses, silver will demonstrate how markets respond when buffers disappear, revealing the true dynamics of scarcity, participation, and market psychology. The culmination of Ghost Week is a stark illustration of how fragile markets can become when multiple stressors align. Each factor, elevated physical demand, thin liquidity, constrained supply, and heightened participant sensitivity, interacts in a way that magnifies the impact of every trade. The projected $8 gap is the crystallization of these forces, a realignment of price that communicates the resolution of tension accumulated over time. It is not an abstract possibility. It is a logical outcome of the conditions present. Market behavior during this period underscores the importance of observation. Premium spikes, regional delivery delays, and unusual order book activity are early indicators that pressure is building. They provide insight into how scarcity is manifesting and how paper markets are likely to respond. Investors and industrial users who recognize these signs gain a clearer understanding of the unfolding dynamics, while those who ignore them risk being caught in abrupt repricing. Automated systems play a crucial amplifying role. Algorithms respond to price triggers and thresholds without regard for context, executing trades that reinforce human behavior and market stress. In a thinly traded environment, these mechanical reactions can accelerate movements, contributing to the formation of gaps. The interplay between human decisions and algorithmic responses creates a feedback loop that magnifies volatility, making the projected $8 movement both plausible and timely. Historical examples reinforce the lessons of Ghost Week. Previous low liquidity periods consistently produced abrupt adjustments when structural imbalances were exposed. Scarcity, combined with participant sensitivity, triggered gaps that surprised even seasoned traders. The current environment mirrors these conditions, with elevated demand and reduced liquidity converging in a way that aligns with historical patterns, suggesting that the market is poised for a similar outcome. The implications extend beyond immediate trading results. Industries reliant on silver may face operational disruptions. Financial instruments tied to the metal will reflect heightened volatility, and market participants gain insight into the limitations of paper representations versus physical reality. The $8 gap is not merely a numerical adjustment. It is the market communicating the underlying pressure, highlighting vulnerabilities, and demonstrating the consequences of constrained conditions. Ghost Week functions as both revelation and test. It exposes the sensitivity of the silver market, the fragility of liquidity, and the importance of monitoring physical flows alongside paper positions. The projected gap crystallizes these lessons, providing a tangible example of how markets reconcile scarcity, demand, and behavior under stress. Observing the unfolding events offers insight into structural vulnerabilities and the mechanisms through which latent pressure manifests. As the week progresses, each movement in price, each shift in premiums, and each delay in delivery contributes to the evolving narrative. The $8 gap will ultimately serve as both outcome and signal, a manifestation of accumulated market tension, and a lesson in how physical scarcity, low liquidity, and reactive behavior intersect. Silver, in this period, becomes more than a commodity. It is a lens through which the dynamics of scarcity, market structure, and human behavior are made vividly clear. In conclusion, Ghost Week is a period of exposure and revelation. It strips away the illusion of stability, forcing markets to reconcile physical scarcity with paper representations. The projected $8 gap is the tangible expression of accumulated stress, amplified by reduced participation and reactive behavior. As silver moves through this period, it will demonstrate with clarity how markets respond when buffers vanish, showing the intricate interplay of supply, demand, liquidity, and psychology in a concentrated high-stakes environment.